Hello friends, today we're going to be talking about what are the two types of real estate investment trusts. What are the two types of real estate investment trusts? Many people understand what a powerful tool real estate investing is, but many of them prefer to be hands-off rather than hands-on. And real estate investment trusts are exactly what the doctor ordered if that is the case for you. And by the end of this video, I want to break down exactly how you can take advantage of this awesome investment strategy. Real estate investment trusts are powerful investment vehicles, but many people don't have a solid understanding of what they are or how they work. So in this video, we're going to dive into the two types of real estate investment trusts by first outlining what those two types of trusts are. Secondly, I want to show you how they work. And finally, dive into these real estate investment trusts and what to look out for. If you're ready, let's go. So what are real estate investment trusts, otherwise known as REITs? So throughout this video, if you hear me say REITs, that's what I'm talking about, real estate investment trusts. What are they? A REIT allows individuals to invest in large-scale income-producing real estate assets. And a REIT is a company that typically owns and operates income-producing real estate assets or related assets. So REITs give us, the individual, the ability to invest in real estate without having to own, manage, or finance these real estate assets that are producing income. And many times these are markets or segments that the typical investor like you and I aren't able to participate in. Think about it. If we wanted to invest in high rises or apartment buildings in New York Cities or a condo complex in Miami, typically we're not going to be able to do that, right? We don't have, maybe have the funds, the resources, or even the contacts to be able to do that. But REITs allow you to participate in some of the best asset classes in real estate known out there. Also, REITs take the complexity out of it. It's very simple, where you just put money into it like you would a stock and receive dividends. It's that simple. So a real estate investment trust company must comply with the Internal Revenue Code, which includes owning income-producing real estate for the long term and distributing dividends and income to shareholders, but they must comply with and meet the following requirements. First off, they need to invest 75% of total assets in real estate, cash, or U.S. Treasuries. Second, they must derive 75% of gross income from rents, interest on mortgages that finance real properties, or real estate sales. Third, they must pay a minimum of 90% of taxable income in the form of shareholder dividends. So what does that mean? That means that money has to be paid out. So if you're involved, if you bought shares in a REIT, the REIT has to pay out on a regular basis 90% of its taxable income to all of its shareholders. So you will receive dividends if you are invested in REITs. Fourth, it must be an entity that is taxable as a corporation. 5, be managed by a board of directors or trustees. 6, they must have at least 100 shareholders after the first year of existence. And the last thing, have more than 50% of its shares held by 5 or fewer individuals. This is nice because it means that a group of individuals can't dominate or control the REIT. It's diversified over lots of shareholders and individuals like you and I. So let's talk about the different types of REITs that are out there. Technically, there's 3 types of REITs. There's equity REITs, there's mortgage REITs, and there's hybrid REITs. But for this discussion, we're going to focus 100% on the mortgage and equity REITs. Let's talk about equity REITs. So typically when you hear of a REIT, most time you're hearing an equity REIT, and they own and operate income-producing real estate assets. So what are mortgage REITs? Mortgage REITs lend money to real estate owners and operators directly through mortgages and loans, or indirectly through mortgage-backed securities. Their earnings are generated typically by the net interest margin, the spread between the interest they earn on mortgage loans and the cost of funding these loans. The challenge with this model makes them sensitive to interest rate increases. So for example, right now we're at a time where interest rates are fairly high. So the challenge with mortgage REITs, it's extra sensitive when you see interest rates rising like they are right now. But simply put, mortgage REITs simply hold mortgages on the properties that most of us own. So if you were the person who wanted to invest in REITs, if you wanted to take advantage of this real estate investment strategy, how would you participate? Well, there's 3 different types of REITs that you can participate in. One is a publicly traded REIT. These are the REITs that you find on any typical exchange like the NASDAQ or the Dow Jones. And they are bought and sold by the individual investor like you and I. You and I can go on any platform we want to, whether it's Robinhood, Ameritrade, E-Trade, and go on there and purchase shares in a REIT. They're also governed by the SEC because they are traded on major exchanges. The second one is public non-traded REITs. These REITs are also registered with the SEC and governed by the SEC, but they do not trade on the national exchanges like the Dow Jones or the NASDAQ. As a result, they are less liquid than publicly traded REITs, but they tend to be more stable because they're not subject to the market fluctuations if the market were to go up or down. So if something were to happen in the market, some bad news came out, and all of a sudden the market, whether it's the Dow Jones or the NASDAQ exchange, started to go down as a whole, and the REIT is a part of that, a non-publicly traded REIT is not going to be subject to it like a publicly traded one would be, just because it's part of a certain exchange, and bad news comes out, which causes everything to go down. The last one are private REITs. These ones aren't registered with the SEC, and they're not traded on national exchanges. In general, private REITs can be sold to institutional investors or an accredited investor, somebody who has a net worth over a certain amount. These are typically more exclusive. So now let's talk about the pros and cons of REITs. What are the pros? Well, first off, it's liquid. The liquidity is nice. Also, you're able to diversify. You're able to diversify because you're part of a REIT that invests in a lot of different asset classes, whether it's apartment buildings, single family homes, but the diversity is extra nice, and that's one thing people really love about REITs. Also, another positive pro is that you receive stable cash flow through dividends. Now let's talk about the cons. One of the cons is typically it can be low growth, where they are diversified over multiple different asset classes. Some go up, some go down. It's typically low growth. You're not going to get some of the high returns that you would maybe if you're investing in a group of tech stocks, but also there's greater risk there, right? Also, a downside is it's taxed as regular income. Typically, when you invest in real estate, if you own a piece of property, you hold it for longer than a year, and you turn around and you sell that property, you're going to be taxed at a capital gain tax of maybe 15-20%. Being part of a REIT and receiving dividends, that income that comes to you is going to be taxed at regular income, which could be anywhere between 25 to 40%. So that is another downside of owning REITs versus investing into real estate yourself. One other downside is you are subject to market risks, as I talked about earlier, and sometimes there's high management or transaction fees. So if you invest in a REIT, I caution everybody, make sure that you go read the fine print to see what management fees are or what transaction fees are to make sure you're not paying out the wazoo on some of the REITs that you're investing in. Now, how can you take advantage of REITs? As I mentioned, you can go buy these REITs on any exchange, whether it's a Dow or NASDAQ, and they usually have their normal ticker symbol. You just go find the REIT and you just start buying shares in it. Some of the bigger ones out there is Prologis, American Tower, or some of them that I really like are the storage unit REITs. And those are American Storage or Extra Space Storage. They have REITs that are focused on the storage unit industry. Now, typically they've seen returns anywhere between 3.5% to 5.5% return, but obviously there's years where they do a lot better, years where they don't do as well, but they're typically around those range. So kind of that slow, low growth rate that you're going to be a part of. Another way that I found really interesting, many of you might have heard of the app called Acorns, where you're able to put money in every single day into the stock market, into a fund, and you just typically put that money in there and it grows with the market. There's an app out there specifically for this, actually a couple of apps called Fundrise and Realty Mogul. I had a good friend of mine that from the years of 2018 to 2021 put money in every single month into Fundrise. And that was when the market really took off and real estate really saw an uptick, and his returns were phenomenal just putting money into the real estate REITs through an app called Fundrise. Now, REITs aren't for everybody, but there are people that fit this model of investing, and I'd be interested in what you think. This is what I've seen with REITs and how I've participated in them, some of the pros and cons, but I'd be interested to hear what you say. So please leave a comment. I'd love to engage in conversation. And as always, I have a free gift for you just for stopping by and watching the video. Just go ahead and click on the link below, aaronsfreetraining.com. It's a short-term rental calculator that gives you all the information you need to know if you're investing into a short-term rental, if it's a good deal or if it isn't. But go ahead and click on that below. Thanks for stopping by. Have an awesome day.